Well, we have a very big day today. Two big positions in my portfolio. Two of the 9 core holdings reported earnings just moments ago. The companies, of course, are Apple and Texas Roadhouse. These are two of the 9 core positions that make up the majority of my portfolio. In Apple, I have a position value of $48,000, $19,000 in gains as of today. Now, I was a little bit concerned about this upcoming earnings, mostly because I was reading reports of Microsoft and other hardware makers that saw sales plummeting. Apple has a huge amount of their revenue from hardware, but the report is out and it's better than expected. They beat on their earnings, they beat on their revenue. They did the thing that Apple does. They beat expectations over and over again. The other company that I have as a major investment, almost the same size now, is Texas Roadhouse. This is a $46,000 position. I'm currently $12,000 in the green, and they likewise just reported earnings moments ago. The news is that Texas Roadhouse missed on their earnings. They missed by 7 cents. Now, not only am I not concerned about their earnings per share miss, but I actually don't think they really missed. And I want to explain this in the earnings report of why I don't think that this is an accurate portrayal of Texas Roadhouse's performance. I read through Texas Roadhouse's entire earnings report, and this has once again convinced me that this company is one of the most well-managed companies in the market. The operations and execution is excellent. In my opinion, it is a masterclass of how to run a company. And I'm very excited to go through this earnings report and illustrate why it's so good. And then finally, outside of Apple and Texas Roadhouse, we also have Paramount that reported this morning and ended the day down 28%. So I'm going to be going over this one and sharing what I believe has gone wrong with Paramount and why I've continually avoided this stock. So having said that, let's go ahead and jump right in, and we'll start off with Apple. Apple reported better than expected quarter driven by iPhone sales. Now, I have to admit, I came out with a video recently saying that I was concerned about Apple's earnings report. And most of the time, this isn't the case. Most of the time, in fact, I've owned Apple for over 5 years. And most of the time, I am not concerned about their earnings report. They routinely beat earnings expectations. If you look over the past 5 years, all the quarterly reports, they've only missed like one time. So they almost always hit their earnings per share. The reason Apple's able to do that is because they have so much flexibility in their business model. They have all these tools to be able to hit their targets. Now, if we look at the actual earnings per share, the earnings per share came in at 152 versus 143 expected. Revenue came at 94.84 billion versus 92.96 billion expected. Like Amazon, they came in over $1 billion of their revenue expectation. Over $1 billion. Imagine being such a huge company that the margin of error is bigger than $1 billion. It's incredible the numbers these companies work with. But Apple beat on their earnings per share, they beat on their revenue estimate, and then even their margins came in slightly better than expected at 44.3. Now let's go ahead and take a look at Apple's revenue segmentation. We have all the different hardware of the company. This is the entry point. This is the Trojan horse that gets people into the Apple ecosystem. But once you're done getting your nice new Apple Watch or your AirPods or your first iPhone, you're in. You're locked into the ecosystem, and then they start to monetize with the services. And the services further lock you into the ecosystem as well. This is the Apple mousetrap, and it works very well. If we look at the iPhone revenue, it came in at 51.33 billion versus 48.84. This is a massive outperformance of expectation. 51.3 versus 48.84. The estimates weren't even close. People keep talking about the recession. It doesn't seem to be happening with Apple's business. People are still buying iPhones at full price whenever they want them. So the iPhone revenue segment dramatically outperformed. Then we have the Mac revenue segment. This one actually underperformed, and the Mac sales are down over 30% year over year. After the Mac, we have the iPad revenue coming in at 6.67 billion versus 6.69. That's barely missing expectations by a couple $100 million. The other products revenue, this is wearables. You have things like the AirPods and the Apple Watch. This came in at 8.76 billion versus 8.43. So another category that they outperformed by a marginal amount. And then we have service revenues coming in at 20.91 billion versus 20.97. So they missed ever so slightly with their service revenue. If we go to Qualtrim and look at the product segmentation breakdown and we cross out everything but the services, we can see the last quarter. It was 20.77 billion. So it grew sequentially quarter over quarter to 20.9. And then from there, it's growing quite steadily. In fact, in 2018, Apple's services were only $10.8 billion. So they've been doubling their service revenue, and it continues to grow sequentially almost every single quarter. That is impressive growth. Whether or not they missed by $100 million is not a big deal. The overall picture here is that directionally, Apple's service revenue is growing at pace. So when we look at the segment basis revenue, I don't think this is too bad. I think this is pretty good considering the headwinds that Apple faces. If you look at other hardware companies, they're going through major down years. So Apple being able to pull this off and basically keep things flat is a good sign. And then them growing revenue in their services sequentially, I also think is a good sign. And I think this was actually tough to pull off. In Apple's case, the company had such a good previous year that the revenue of $94.8 billion was actually down 3% year over year. And the quarterly earnings per diluted share of $1.52 was unchanged. So revenue's down a couple percentage points and earnings per share is unchanged. Now, Apple doesn't give guidance, so we don't know exactly what they expect for the year ahead, but the analysts will probably say that they're going to resume growth in the future when we get through this cyclicality. Now, in this same earnings press release, Apple also mentioned that they're raising the dividend by 4%. A 4% dividend raise is puny. That's not what I'm looking for with my companies. Most of my companies raise dividends above 10% per year, in a lot of cases above 15% per year. So 4% is a very small dividend raise, and it's mostly symbolic. They're just keeping their dividend growth story alive. Where they're really returning capital back to the shareholder is in the case of buybacks. They authorized an additional $90 billion in share buybacks. So they're directing their gigantic cash flow and cash balance into buybacks. Now, so far, the market's reaction is Apple's up 1.5% after hours. This is always very volatile. It could trade around in a matter of minutes, but I think investors are pleased with the results, pleased with the buyback policy, and pleased that the expectations were met and even exceeded. So in reality, the market's celebrating Apple's report. It's going up after hours. They beat their expectations. But when I look at it, I didn't really love the report. And I say that as a huge Apple bull. I love the company. I love the progress it's made over the past 5 years. But looking at an earnings report and the progress of a company where revenue's down 3% and earnings are completely flat on a company that trades at a 25 forward PE, it's not the best earnings report I've ever seen. I need Apple to continue to grow on both its earnings, its revenue, and its free cash flow. Now, I give some leniency with a company of this quality. They will go through times where they have cyclicality and where they have temporary headwinds. I believe that's what Apple went through in this earnings report. But in terms of my instant reactions, there's nothing in this report that made me super excited. Nothing stuck out as particularly exceptional. The basis of the report is that Apple's still the same company it was yesterday. That's what investors found out in this report. It's the same company with the same moat, selling the same amount of iPhones. So it's business as usual. Now, moving on to an earnings report that I did think is exceptional. In fact, this is the best earnings report that I've read so far in this entire earnings season. We have Texas Roadhouse. And I know you might think that sounds a little funny. This is a restaurant company, and I'm saying it's what I believe is the best earnings report of the earnings season that I've read so far. It is the best one, operationally speaking and execution speaking. And this is also funny considering that Texas Roadhouse missed their earnings per share. They missed it by 7 cents. This is what investors focus on. They go to Seeking Alpha or they go to CNBC. They look to see if the company missed their earnings expectation or beat it, and then they judge the company instantaneously based off of that. That's not what I do when I'm doing analysis on earnings report. And in the case of Texas Roadhouse, not only do I not believe that it's a problem that they missed their earnings per share, but I don't believe they really even missed it. I believe this was a deliberate decision by the company. They could have easily surpassed their earnings per share if they chose to. And I also completely disagree with the market's reaction after hours. Trading down the company by 4% after hours on these earnings, I think, is a complete mistake by investors. This earnings report was phenomenal, and it is a masterclass on how to properly run a business. Trading down the company 4% after this good of earnings, I believe, is a huge mistake by investors. And if the company continues to sell off, I will be adding more to my position. Now, let's go ahead and dive in to why I like this report so much. We have it right here in front of us. This is Texas Roadhouse Q1 of 2023. Let's first just go ahead and take a look at the top line and bottom line of the company. Texas Roadhouse grew revenue at 18.9%. They grew diluted earnings per share year over year by 18.4%. Texas Roadhouse grew both their top line and their bottom line faster than Apple, Google, Microsoft, Meta, and Amazon. They outgrew all of them in both earnings per share and revenue. Revenue growth of almost 20% is difficult to find in this market. Most companies are doing what Apple's doing. They're shrinking. Their revenue's going down year over year. And then on top of that, seeing revenue grow by almost 20% and then earnings per share grow by 18.4% is very impressive. So this company's overall metrics show growth. This is a fast-growing company. It's on the move, and it continues to grow at a rapid pace that it has for years. Now, this is a restaurant company. When we look at some of the specific metrics to restaurants, they're also top of their game. They're top of the entire industry. They grew their same restaurant sales by 12.9%. So same location sales increased by 13% year over year. Now, to put that in perspective, growing your comparable restaurant sales by 12.9% is faster than both McDonald's and Chipotle. And Texas Roadhouse is a sit-down restaurant, not a quick service restaurant, which makes this report all the more impressive. Now, they had the earnings per share growth of 18%. They opened up 6 new company restaurants. They purchased back 8 different franchise restaurants. When they buy these back, they routinely operate them with higher profits than their franchise operator. So they like buying back the franchise-owned restaurants. That ups their profits over time. And then they also purchased back 92,000 shares for about $10 million. So they're doing share buybacks as well. I think it's incredible how seemingly mundane companies like Texas Roadhouse can have incredible results when they have proper execution. Now, the CEO does have a little paragraph here where he says one overview of the company and some things that they're focused on. And it may surprise you, but the CEO of Texas Roadhouse did not mention artificial intelligence a single time. So that may be why the stock is trading down right now. Maybe it's the lack of artificial intelligence. He says, quote, "On our capital allocation front, our development pipeline remains strong. We acquired 8 domestic franchise restaurants, and we further strengthened our capital position by repaying the remainder of our debt. We are confident that our restaurant growth, commitment to our operating fundamentals, and the strong balance sheet will continue to provide us with flexibility to generate long-term shareholder value." And this is where we really get into the deliberate decisions the management makes, which I think are excellent long-term decisions, sacrificing the short-term optics for the long-term future of the company. He says right up front that we repaid the remainder of our debt. That's something that he wanted to highlight, that the company's completely debt-free. Last quarter, Texas Roadhouse had $50 million in debt. So they paid back all $50 million, and currently they have 0 long-term debt. Now, this is a deliberate decision from the management to pay down the remainder of this debt. They didn't need to do this. They weren't in any real trouble. They could have just held on to this debt, or they could have even taken out more debt. In fact, one of the things that Texas Roadhouse could have done, if they wanted to, was use this money, the $50 million, to buy back additional shares instead of paying down debt. If they bought back additional shares, it would have removed more shares outstanding, making their earnings per share calculation look a little better. If they made their earnings per share calculation look a little better, then they would have hit their earnings per share target. And that's why I say that I don't believe Texas Roadhouse really missed their earnings per share, not in the same way other companies do. Rather, the deliberate decision from management was to, instead of focusing on short-term optics and hitting the 7 cents earnings per share, they wanted to make their company less risky. They paid down debt. They did what was responsible. They reduced risk in their business overall. And they chose to do that over buying back more shares and making sure they hit the analyst estimates. This company could have easily hit this earnings estimate. They could have easily came in above it. Literally, the only thing they had to do was use this money to buy back shares instead of paying back debt. That would have made them hit their EPS target. Better yet, they could have done what a lot of companies do. They could have raised more debt and used that to buy back more shares, further increasing their earnings per share. They could have boosted their earnings per share growth well above 20%. But management decided not to do that. And I think the reason they decided not to do that is because the shares are going up in price. Over the past year, the share price is up 42%. So while they did a lot of buybacks last quarter, They slowed down the buybacks this quarter and instead allocated the capital into long-term debt. They focused on buybacks when shares were cheap, and now that shares are a little bit more expensive, they're focusing on paying back debt. I really like the decision from this management. I think they're excellent capital allocators, and I really appreciate the fact that they're focused more on reducing overall operational risk in the business than they are boosting short-term earnings. Now, in terms of their forecasting, this also looked really good. They say that they expect comparable restaurant sales to grow. They're going to continue to grow year over year at a rate of around 8.6% compared to 2022. I think that's very strong comparable restaurant sales year over year. And they say the company implemented menu price increases of approximately 2.2%. This is again long-term focused, only 2.2% menu price increases. They could flex their pricing muscles more. They could do what a lot of other restaurants are doing and really jack up prices. But they're focused on the long term. They don't want to offend their customer. They want to remain the best value proposition of any steakhouse by a mile. And they do that by having slow and incremental price increases. Over the course of this year, they're expected to open 25 to 30 new Texas Roadhouse restaurants and Bubba 33s. They also may open a couple Jaggers, but those are very slow moving. So the majority of their new restaurants are going to be Texas Roadhouses, and then there's going to be a few Bubba 33s mixed in. Their CapEx is expected to be $265 million. This is almost entirely from new restaurants. So that $265 million is just paying to build new restaurants. They don't waste money on other pet projects. They return the excess cash back to the shareholder. Now we can look at the income statement. We know the company grew their revenue around 18% and their earnings per share around 18%. Another thing I'd point out is that they're now doing a decent amount of buybacks. This is something that they weren't previously doing. Texas Roadhouse for years was never doing buybacks, but now they've scaled to a point where they have enough free cash flow that they're raising the dividend by 16% plus per year, and they still have too much cash. So not only have they paid down the debt to zero, but they are buying back shares very opportunistically. Over last year, they reduced the amount of shares outstanding from 69 million to 67 million. That's a reduction of around 3%. And then finally, we get to the cash flow statement of the company where we can look at the free cash flow. Their cash from operating activities was 189 million. Their CapEx was 66 million. That leaves us with 122 million. Now, the reason their free cash flow went down is they spent $20 million more on CapEx this year than last year. And that's because they're investing more. They're opening up a greater number of new restaurants. So in terms of their traditional free cash flow, they're sacrificing a little bit of their free cash flow this year to have a greater number of restaurant openings. And given the returns they get on each restaurant, this is a trade-off that I like. I'd like them to invest as much as they want into CapEx, because CapEx means more restaurants means greater free cash flow in the future. Now, on a different note with this company, we always look at the stock-based compensation. In Texas Roadhouse, this really isn't a big concern, but I'll note that the stock-based compensation actually declined year over year. So the executive team and the managers that are earning stock are paying themselves a little bit less this year. This is tight control over costs. This company does not try to take advantage of the investor by transferring all of the money the investors put in to the executives through stock-based comp. And that's something that I really, really like to see with this company. So the 10-second summary of Texas Roadhouse is they grew revenue by 19%, earnings by 18%, same restaurant sales by 13%. They opened up or acquired 14 new restaurants. They bought back 92,000 shares. They're growing the amount of cash from operations. They're opening stores at an accelerated pace, and they're reducing the amount of stock-based compensation. So where is the real weakness in this report? Where did this company fail to execute? I don't see weakness anywhere. I saw an excellent report top to bottom, even through thorough inspection. And the fact that they missed their earnings per share estimates by 7 pennies is not a concern. They could have easily chosen to do what a lot of managers do, which is manufacture earnings per share by boosting the amount of buybacks. Since the stock price has raced up, they've decided to instead focus on paying down debt, which is the right decision. So overall, needless to say, I like the report. I'm not considering selling the company. If it does trade down further, I will be looking for opportunities to buy it. Now moving on, we have another big company here that we got to get to, which is Paramount. This company reported earnings this morning, and it's been a doozy. Now, this is not a holding of mine. In fact, I've been quite outspoken, and I'll say with a lot of resistance, I've been outspoken in discouraging investors to pursue this stock. I've not agreed with Warren Buffett on a couple of holdings. I disagreed with him on Verizon. I disagreed with him on Ally Financial. I disagreed with him on Paramount. I agree with him on Apple. I think that's a great buy. But Paramount is one of these companies where I just don't see what Warren Buffett sees in the company. I don't know why he has such a huge stake in it. And he doesn't even seemingly know why as well. During his interview on CNBC, when he was asked why is he buying Paramount, he practically did a 2-minute soliloquy explaining why the entire business is bad. It has poor economics. The people that benefit from it are the rich movie actors and not the investors. And then finally, when pressed on it again, Warren Buffett, why did you buy Paramount? He said, we'll see. And they laughed. That was his answer. We'll see. Well, here we are. We have Paramount and it's down 28%. We have a note here from Qualtrim saying that Paramount Global shares are trading lower after the company reported worse than expected Q1 financial results and cut its quarterly dividend. And they note in the report that they cut the dividend down to 5 cents. So from 24 cents to 5 cents is about an 80% reduction. So a lot of investors right off the bat are thinking that this has been a tough company to hold. They're down 45% over the trailing year. It's widely underperformed the rest of the market, but at least they have the fat dividend, that healthy dividend that's paid out every single quarter. And here we have Paramount deciding to take that dividend away. So that's obviously going to have a negative reaction from the market. Let's go ahead and take a look at what's actually happening with their core businesses. And I think this is the biggest highlight, the biggest positive of the entire report. They gained 4.1 million subscribers and they have a total of 60 million subscribers. So they are growing in subscribers, which is the biggest part of this company's future. Where we get to the trouble are in the financial metrics. If we look at the losses that streaming has had over just the past 3 months, it's lost over $500 million in the past 90 days. 511 million to be exact. And the losses have increased by 12% year over year. So even though streaming's growing, the amount of losses are also growing. The hope here is they can turn to Netflix and they can get to that huge scaled economy where they finally become free cash flow positive. That's what the management's trying to do. So if they have that end goal in sight, maybe they can turn this around. But this does paint a grim picture. They're growing subscribers, but they're also growing them very unprofitably. TV and media is their next big business segment. And this is actually their only positive, their only profitable revenue segment. So this is what's generating all the money right now to pay for all the other money-losing segments of their business. The problem with the TV media portion, it's an antiquated business that's going down over time. This is linear TV. We can see that they generated a positive $1.3 billion in profits, but that's down 15% from last year's $1.5 billion. So this is the challenge with Paramount. It's a race against time. The TV media portion of the business is in secular decline, and it's declining in profits while they're trying to grow their unprofitable streaming service. They need the streaming service to reach profitability before this part completely becomes unprofitable. The last segment of their business is filmed entertainment, which is movies. This segment of the business did not have a great quarter, and this is a little bit surprising. You think they'd be able to generate really big profits from all of their big box office movies, but they lost $100 million last quarter. And that's more losses than they had the quarter prior. So this may be a cyclical part of the business. They may have different parts where they generate more profits based on their movie releases, but it's never good when the company's losing money in every segment but the TV portion. So this is a company that really has a predicament. Paramount Global has excellent assets. The movies and franchises and TV shows that they have are excellent. When you look at the things that they own and the trailers they come out with and the movies they continually make, they are really, really good. I'd say they're even better than Netflix. They have incredible IP, but they don't have the distribution. And when it comes to making money, distribution's everything. Netflix may not have as good of core IP as Paramount, but Netflix has the massive global scale distribution, that massive 230 million subscribers. Paramount's stuck in a situation where they have lots of good assets and they don't have good distribution. Their distribution channel of legacy TV is in secular decline, and their distribution through streaming is very difficult to grow amongst all the competition. So I believe the only way for Paramount to really come out on top, at least the shortest way and the most practical way, is through an acquisition. The company trades at a very low valuation. Right now, Paramount is below a $15 billion market cap. It's now getting closer to a $10 billion. So this is in the range that a lot of bigger media companies will start looking at it for an acquisition. So if I was a Paramount investor, the thing I'd be hoping for right now is for another very hungry media company that's looking to bolster their IP with the library of Paramount to do an acquisition. I think that's by far the quickest way for this company to actually turn into a half-decent investment. So overall, that's my thoughts on the recent earnings. Apple's earnings was meh. I thought it was okay. Apple's the same business it was yesterday. It's business as usual. Texas Roadhouse's earnings, a masterclass in business operation. They execute perfectly. They reduce risk. They look at the long term, not the short term. I love almost everything this company does. And then with Paramount, I'm not buying this dip, but I'm crossing my fingers for you Paramount shareholders that you get an acquisition. Now that's going to be it for this episode. I hope you enjoyed, and I'll see you in the next one.